Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back. Investor Coaching Show, Paul Winkler, along with Dan Hill. We're hanging out talking about money. So, Danny, what was it you wanted to add on the last little?
So I talked about this the other day. So a year or so back, you know how we get frequently emails inviting us to all kinds of events. It was an event held in here in Nashville about alternative investments.
Oh, yeah.
So I signed up for it because if you're really going to be
You're a glutton for punishment.
Well, we gotta know. I mean, if we're fiduciary,
so define alternative investments for
well,
everybody.
that's a part of it. Well, what is an alternative investment? So real estate, gold, commodities, Bitcoin.
And why would real estate be an alternative investment? And let me just answer that real quick.
Please do.
So if we look at it and say, why would that be an alternative investment? When I own stock, I own companies, and those companies own real estate. So I already have a tremendous amount of exposure to real estate when I own stock in the stock market. So, Ray Kroc was famously asked, hey, what kind of company you got? And people think, burger company. And he goes, no, it's a real estate company. So in reality, this is one of those things that we think that it's a different area of the market and we already have exposure to it. So we don't use real estate as a separate asset class in an investment portfolio for that reason. But anyway, so
and
other
also,
alternative investments.
because the science and math, and it doesn't increase return, reduce volatility or anything. I mean, there's data that supports what you just said.
No, that's great, Dan. Yeah, so that's exactly right. So it doesn't help risk-adjusted returns, and that's what we're looking at.
Yeah. So I go down there and listen, like I said, because if you're going to really act as a true fiduciary and make sure that you're bringing the best things to your clients and acting in their best interest, you shouldn't try to become an authority on everything so you can tell them why, which I had to do to that guy yesterday. Why not real estate? Right. And I told him, why not gold? And I told him what we tell him.
Right.
And
why not Bitcoin?
They had a little breakout session last year at that thing. And I told them what you just said. This is why. There's no scientific, academic research. This is blah. Okay. So
Silence.
Then fast forward a few months ago, they invite me to speak at one in Kiowa Island and take me golfing. So that piqued my interest, of course.
That'll do it for you.
So I called. I said, do you really want me to speak at this? Because this is what I'm going to say. Yeah. And they went, no, I don't think we want you to speak.
It was like getting me to speak at the investment clubs in the late 90s. People would invite me to speak in investment clubs. And I would say, you don't want me to. I'll ruin your investment club.
Well, that's what I told them. So I said, I still want to come. Make sure I'm not missing the boat. Make sure I'm doing what's best for my client. So I did go. Yeah. Met a person there that asked me to get on a panel just a couple of weeks ago. I thought she had just invited me to listen in, but then I got her uncle. I'm on the panel.
I'm on the panel.
So anyway, now I'm getting to the point. Called her the other day and said, hey, thanks for putting me on the panel. It was fun, blah, blah, blah. And I tell her a little bit more about what we do. And we do tilt toward value investing.
Yeah, value and
companies in distress because the science supports it.
Right.
And she said this is getting back to the stock price. It's very hard to do value investing now because no one can determine when something's underpriced.
Oh, gee.
Okay, yes.
She didn't even know what value meant.
Well, she did, but it's pretty intelligent people.
That's just that by definition, she missed the definition of what value really is.
And I did. I won't mention her name. And I went, come on now.
And that's a person in the investment industry.
Oh, yeah. They manage $4 billion. But they're contrary. We're the contrarians, I like to think. They do it the active way, and we do it the passive way. And I said,
it says, to recognize that everybody hates, the academics hate passive because there's a lot of activity going on.
There is. Yes, I tell people, it's still managed. It's just not
stock picking and market timing.
Yeah, right. It's not choosing between McDonald's and Wendy's. We eat all their burgers.
No, we don't.
You don't.
Figure
I
yourself.
do. You'll see on the podcast that but I said, that the price of a stock is the price of stock because, like you said, everything that's known at that moment in time is known.
Right.
Okay. And
Yeah.
so there's no such thing as an underpriced stock. Okay. And value investing, because I just went to nerd camp and reported back to you that and that's why we go to these things, because that data shows that value premium still exists.
Right.
As we add new data to the last 70 years.
And what he just said in English is that historically value stocks outperform growth stocks. So
by 2%, and it's still there. That premium
it
still
depends on
exists.
the asset and part of the asset class. Sometimes it's even higher than that, but it just depends on
so
which
it's just
area.
funny that this intelligent person in the industry for years doesn't think value investing exists.
But I think it's funny. This is the definition.
Right.
It's hard to find undervalued stocks. Well, good. You're getting there. You're understanding that markets are efficient.
Right.
She misunderstood that you weren't talking about market efficiency when you were talking about value.
But she even said that, though. I'm going like, okay, well, if you know what market efficiency is, but you know this because we deal with it all day. How are we going to convert people to go down the right path?
No, I don't think that you ever do.
No.
It's
keep
like
trying.
that was a question that was asked from Eugene Fama, the guy that won the Nobel in 2013. So what if everybody started to believe what we believe? And I said, what would markets still be efficient? And he said, yeah, because people would still make trades. But the reality of it is the likelihood of that happening is somewhere between slim and none, because humanity being who they are. I mean, the thing is, we've known data forever that gambling casinos aren't a good idea. Right. And what's happening is we're seeing more and more gambling out there, not less. Matter of fact, there was an article in the Tennessean this week. Good transition. It was risky business. Young Americans see alternative investments as a path to wealth. And it said that younger Americans are flocking to high-risk alternatives to traditional investments in 2026, driven by the conviction that crypto, gambling, meme stocks, gambling, prediction markets, gambling, my commentary added, offer better odds for meeting their financial goals. And, so you look at that and say, well, it used to be that if I wanted to gamble, I would have to run to Vegas or, maybe Atlantic City or something like that. But now you just, get on your phone and you can gamble on a sports game, or you can gamble on who's going, the politics. Look at that. You're gambling, gambling on politics. Who's likely to get elected? What's the odds that the Republicans are going to retain the House in the fall, and blah, blah, blah. You hear that kind of stuff and you go, just shake my head. And then you got meme stocks and these people gambling on the value of various companies and trying to figure out whether they're going to go up or go down. Shorting stocks, for example, that's huge business. You're gambling on a stock going down in value. So the reality is that the likelihood of humanity changing is somewhere between slim and none, because we have our human nature, our dopamine. I get a hit out of jumping on there and buying and selling. And then you have these companies, these broker dealers and brokerage firms setting it up so that if you buy a stock, all of a sudden you have confetti flying all over the place and the excitement that comes out and the cheering, you'll hear cheering in the background, and whatever. They're doing everything that they can to incentivize people to continue to engage in that type of activity, unfortunately.
Yes. No, so getting back to your other story about people being embarrassed when we, tell them the right way to do things and they don't. I had another guy that we said, who wanted to buy muni bonds. Mm-hmm. And I said, no, same thing. No, not good.
Right.
I don't do stuff that's not good for you.
Right.
So he went back to the previous advisor who told me he did not like it all. And when he came, he said, I bought some muni bonds from my guy. I said, I thought that you didn't like that guy. He said, well, you wouldn't sell me muni bonds. I said, no, I'm not. I'm not going to sell you stuff that's not good for you.
Case in point.
And then he bought a little bit of crypto. Now this guy, for him, it was kind of his game.
Right.
Anyway,
I bet the other guy's really nice, though.
He is, and he's good at the thing.
That's what I'm saying. They're nice. I mean, so it's an emotional decision. It had nothing to do with logic.
This guy had enough. He wasn't embarrassed that he called the other day and said, okay, I lost a lot. I messed up on the munis. I messed up on the crypto.
Oh, so, he admitted it. No, that's really good.
I'm going to listen to you guys from now on.
Yeah, good for him.
That's good. Yeah.
No, good for him. So, why not muni bonds? This is something that a lot of investment advisory firms are pushing, nowadays. The idea behind muni bonds is a municipality borrows money and they can borrow money at a lower interest rate than a corporate that is of similar risk. And the reason being is there's some tax breaks, and the government and the states and the local municipalities have a deal with each other that happens. But for that to be a benefit, the difference in lower return that you get to make sense, it has to have you have to have a big enough tax bracket that you're in that it can make some sense, number one. Number two, the other issues is this. A lot of municipalities and muni bonds will have very, very long durations. And what that means in English is that when interest rates go up, they can go down significantly. It's not unusual to see some of these muni bonds. I've seen them with durations of 2022. And what that means is that if interest rates go up by 1%, they can go down by 22%. So there's a seesaw effect that it literally, you'll have one going up and one going down. And when we have looked at periods in time when things have been, inflation's been a little bit hot, you end up with a situation where those bonds can drop precipitously because the durations are so long. And that is the problem you run into. Now, typically, is it a good idea to have anything with a little bit longer duration in a portfolio? Yeah, it is. It's okay to have durations of maybe 4 to 5. I typically don't like to go out much past that. And the reason being is that when stock markets get real soft, the reason that they get soft is because the economy looks like it's going to go down, or it is going down, let's say. If the economy goes down, and all of a sudden, people aren't buying as much stuff, how do we get them to buy things again? Well, we drop interest rates. And if you can drop interest rates, you can incentivize people to start to buy things again, cars and houses and those types of things. And that brings the economy back. So you'll see that those two things will operate together. Well, if interest rates go down, what does that do to bond prices? It drives them up. So having a little bit longer duration. Now, when we have in the past, 10, 15 years, we have seen stock markets been pretty hot, right? And if you're seeing that bond funds that are of longer durations haven't had real high returns, it's been because when stock markets are hot, you will actually see those interest rates start to climb. And when they climb, that drives bond prices down. So you'll see that they don't have a lot of performance going on. We had this question that came up this week, as a matter of fact. Somebody goes, hey, I think I'll just take money out of longer term bonds and stick them in a savings account. And I was like, that's a really, really bad idea. Do you know the yield to maturity on the bond fund that you're looking at pulling out of? And well, no. And so, well, if you look at the yield to maturity, that yield to maturity is every bit as high, if not higher, than the thing you're thinking about going into, number one. But number two, if that negative in the stock market happens and the economy happens, you don't get that bump up in value with those types of fixed investment CDs. Matter of fact, the interest rates tend to go down. It's just the opposite effect. And the reason being is that they're based on very, very short-term maturities. Bad idea. So, but, just trying to get people to understand this stuff, it's hard, because it is complicated, but I think it can be understood. But I think that you just got to recognize, I think more than anything, I try to get people to recognize, Dan, that this can be understood.
Right.
And that there
agreed.
is science behind it. There is a lot of research behind it. And I think that's the key, is helping people understand that this isn't just flying by the seat of your pants when it comes to, how do you choose investment vehicles in a portfolio, that there is a lot of thinking behind it and a tremendous amount of research using data going back over 100 years. So
right.
Anyway.
And we can teach people. It's not that complicated.
Yeah, and you don't have to know everything.
Right, keep it on the base. But Paul, the point you made about the tax bracket.
Yeah.
This guy is in a heavy tax bracket.
Oh, he was in the tax bracket that would benefit him.
Depending on how much you put into munis.
But the problem is that even if you're in the right tax bracket, the duration is a killer.
Yeah, but he only put in a small amount relative.
Right.
So this is
good, because when the interest rates have gone up recently, that didn't hurt him as much.
Well, yeah, but he was only going to save a few $1,000s. Now, I'm always trying to save people.
I see where you're coming
I'm always
from.
trying to save people $1.
I see where you're going. Yeah.
But his $500,000 tax bill.
If you were really, really certain about this was going to be a great trade, you put all your money there. Okay, I'm with you now.
Yes.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one.
Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.